Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. What if I told you that when a major Wall Street analyst, slaps a massive 50% upside target on your favorite stock,
Yeah,
that it might not actually be a promise of future riches,
often it isn't.
right? In fact, it might actually be a blaring warning sign that the stock is about to see some really wild, potentially dangerous swings.
Absolutely. It's a huge misconception.
Okay, let's unpack this. Because today, our mission is to dive deep into the completely confusing, sometimes totally contradictory world of Wall Street target prices. We're looking at what these numbers actually mean, why they're fluctuating so wildly right now in our current 2026 market, and most importantly, how an everyday American investor can use them without getting burned.
Yeah, and that's crucial.
Because understanding this, it isn't just about learning high finance jargon. It is an absolute survival skill for navigating today's stock market.
It really is a foundational survival skill. And the very first step to surviving, honestly, is shattering the illusion that these target prices are some kind of financial prophecy.
Right, they're not a crystal ball.
Exactly. They're not a crystal ball. When a brokerage issues a target price, it's typically just a 12-month projection of where they think the stock could go. But it is absolutely not a mathematically guaranteed future.
So what is it then?
Well, in the industry, we call it a conditional scenario. It's a single number built on a really fragile stack of assumptions.
A fragile stack.
Yes, like we're talking about assumptions regarding a company's future sales growth, their operating margins.
This means what it costs to run the business versus what they actually get to keep, right?
Spot on. Operation margins, currency fluctuations, broader industry cycles. If even one of those underlying assumptions shifts in the real world, the entire target price shifts right along with it.
It's a lot like baking a cake.
Okay, I like that.
Like, if you assume the oven maintains the exact right temperature and nobody opens the door, the cake will be perfect.
Right.
But if the power flickers, which is basically a market shift in this analogy, the cake just falls flat. The recipe was perfectly right, but the reality of the kitchen changed.
That is the exact mechanism at play here. The financial model requires a completely stable environment to be accurate.
Yeah.
And right now, in late June 2026, the economic environment is just incredibly dynamic.
Oh, it's wild right now.
Yeah, under the current Trump administration, the market is navigating this really complex web of overlapping factors. We have this massive ongoing artificial intelligence investment boom colliding head-on with shifting geopolitical trade policies.
Right, and ongoing fears over what the Federal Reserve is going to do with interest rates.
Exactly. When you look at the market data from just a few days ago, you actually see this volatility play out in real time.
Yeah, let's talk about that.
So on a Monday, in late June, according to the data, strong future outlooks from major companies like Micron and Qualcomm, they added over $400 billion to the market capitalization of AI semiconductor stocks.
$400 billion?
$400 billion of assumed future growth just priced in almost instantly.
Wow.
But then, by Wednesday, the PHLX Semiconductor Index, which is the major index tracking all the biggest chip makers, it plummeted. It dropped 5.3% and actually finished the week down nearly 8%.
Wait, really? So we saw hundreds of billions of dollars of value added on a Monday because of an incredible earnings outlook, and by Wednesday, the entire sector was just tumbling.
Yes, what's fascinating here is that the fallout from that kind of whiplash is just sheer confusion for the retail investor.
I would be confused.
Right, because stock prices and the underlying earnings forecasts, they don't always move in the exact same direction. When an everyday investor sees a target price jump from $100 to $150 overnight, they might assume the analyst is just making an irresponsible guess to hype up the stock.
Like they're just pumping it.
Exactly.
Yeah.
But usually, it's a real-time shift in those underlying conditional assumptions we talked about.
Oh, I see.
The analyst is updating their model based on a shiny new piece of data from the company. But the broader stock market might be selling off because of something completely different.
Okay, but if the recipe is right, but the reality of the kitchen is changing that fast, what are the specific inputs that are messing up these models right now?
That's the million-dollar question.
Because it feels like the market is running on two completely different engines and they just aren't working together.
You are spot on. It is running on two engines. Stock prices run on corporate earnings, yes, but they also run heavily on discount rates and market psychology.
Okay, discount rates. Break that down for us.
Yeah, let's break down discount rates, because
Yeah.
it is the invisible force driving the market right now. Even if companies' earnings are absolutely fantastic, they're selling products left and right.
Raking in cash.
Right. If broader interest rates go up, the present fair value of that stock drops.
Why is that?
The logic here is just basic human behavior. If you can get a guaranteed, completely risk-free return of, say, 5% from a U.S. Treasury bond, because rates are high,
You take the sure thing.
exactly, you're going to demand a much higher potential return to risk your hard-earned money in the volatile stock market.
That makes total sense.
And conversely, you could have a company with pretty mediocre earnings.
Hmm.
But if there are sudden rumors that the Fed is going to cut interest rates, that stock can shoot up.
Because money becomes cheaper.
Yes, money becomes cheaper and risk becomes much more palatable.
So the broader interest rate environment can completely override the actual tangible business performance of the company on any given day.
100%.
That makes sense, but it also leads to some seriously confusing messaging from Wall Street institutions. I mean, based on recent analysis, JP Morgan recently provided a perfect illustration of this paradox.
Oh, the June report.
Yeah. On June 24th, they raised their 2026 year-end S&P 500 target to 7,800. And they explicitly cited strong earnings momentum and the AI boom as the reason.
Which sounds incredibly bullish.
Right. But practically in the same breath, from the exact same institution, they issued a warning about a flash crash risk because too many people were crowded into momentum trading in those exact same AI and semiconductor stocks.
That's dizzying.
You have two completely conflicting messages existing simultaneously. One says the market is going up, and the other says it's at risk of a violent crash.
And the really frustrating part is that both statements can technically be true within their specific, isolated models. But this highlights the fundamental flaw we're talking about today. Analyst models generally assume a normal functioning market.
Wait, so these analyst models basically assume a normal functioning market, but the market is rarely completely normal.
Rarely. They calculate revenue, they calculate profit margins, and they spit out a nice, neat number.
How do analysts account for sudden shocks then? Like a leverage liquidation? We hear that term thrown around, but really, for anyone listening, that's just a fancy way of saying big Wall Street funds borrowed a ton of money to buy stocks, the market suddenly dipped, and their brokers forced them to sell everything at fire sale prices just to pay back the loans. Or ETF redemptions, where regular people panic, sell their index funds, and the fund manager is automatically forced to dump millions of shares regardless of how well those specific companies are performing. How is any of that chaos baked into a pristine 12-month target price?
Well, the short answer is they cannot bake it in.
They just ignore it.
They don't ignore it, but financial models inherently lag behind real-time events. Think about the physical workflow of a Wall Street analyst. A target price report only comes out after an earnings call has happened, after corporate management meetings have taken place, or after a major piece of industry data is officially released.
Right, it takes time.
Yeah, the analyst has to sit at their desk, crunch the numbers in their spreadsheet, write a comprehensive report, get that report approved by compliance, and then finally publish it.
And by then?
By then, the actual stock price is moving by the millisecond on the trading floor.
Wow.
Research on highly volatile stocks notes that this delay can actually be incredibly dangerous. When sudden bad news breaks, the stock price plummets immediately.
Naturally.
But if the analysts take 3 days to adjust their models downward, the consensus target price, meaning the average target of all the analysts covering the stock, it remains artificially high.
Oh, I see where this is going.
Yeah. An everyday investor logs into their brokerage account, looks at that artificially high target price, looks at the crash stock price, and assumes it's a massive generational bargain.
When in reality, the target price is just outdated. That is a massive trap for a beginner. You think you're buying the dip, but you're actually just trading on old information.
It happens every day.
And I think that leads perfectly into the mystery of the wide range. You look up a stock, and you see 5 different professional analysts have issued 5 wildly different target prices for the exact same company.
Oh, the ranges are huge lately.
One says it's going to $100, another says $250. It's incredibly frustrating for an investor. It feels less like math and more like they're just throwing darts at a board while blindfolded.
You see that all the time, especially with tech stocks. But that wide range, it's actually a crucial piece of data for you.
Really?
Yeah. It is not a sign of bad math. It is a blaring signal. A wide range usually signals three very specific things. First, it means there is massive professional disagreement on the future profits of that specific industry.
Like AI right now.
Exactly. Take the AI optimists versus the pessimists right now. The optimists look at the landscape and see years and years of massive data center capital expenditures ahead.
Meaning the physical buildings and cooling systems required to run AI.
Right. So they plug in high sales growth and high profit margins for the chip makers.
And the pessimists?
The pessimists look at the exact same landscape and see a looming glut of supply and falling returns on investment, which will eventually crush those margins. If you plug those two completely different worldviews into a spreadsheet, you get vastly different target prices for the exact same company.
It's like asking 5 meteorologists how long a cross-country road trip is going to take in December.
Good analogy.
Like, if they all say about 5 days, you can be pretty confident the weather is all the way through. But if one meteorologist says 5 days and another says 12 days and another says you might have to pull over and wait out a storm, that wide range of answers isn't because the meteorologist forgot how to calculate distance and speed. The wide range is the blizzard warning. It tells you there is a massive, unpredictable variable in the atmosphere that could completely change your trip.
The wide range is the blizzard warning.
Yeah.
Love that.
And the second thing it signals is a disagreement on those discount rates we talked about, which, again, are heavily influenced by Federal Reserve rate expectations.
Right.
If one analyst thinks inflation is fully tamed and interest rates are coming down quickly, they give the stock a premium valuation. If another thinks inflation is sticky and rates will stay high, the target price drops.
So it's macroeconomic guessing.
In a way, yes. In fact, when we look at the data surrounding that big technology and semiconductor drop in late June, inflation data and Fed rate hike possibilities were specifically cited as the background catalyst.
Makes sense.
And the third thing, a wide range signals, is simply low market conviction overall.
What does that mean in practice?
It means the stock is likely a messy turnaround story, a cyclical business that booms and busts, or sitting right in the middle of a massive bubble debate.
If the models lag behind reality and the target ranges are a mile wide depending on who you ask who is actually using this data, why is Wall Street still churning these out every morning? Well, if we connect this to the bigger picture, you have to look at the institutional motive. Brokerages do not spend millions of dollars publishing research to give retail investors a cheat code for free money.
Shocking.
Right. They publish them to create a baseline for conversation with their massive institutional clients, the big pension funds and the hedge funds.
Ah, the big players.
Exactly. An analyst simply saying, buy this stock, is completely useless to a fund manager managing $10 billion. The fund manager wants to know, under what specific assumptions is this a buy?
Right. What is your revenue growth expectation for next year?
Exactly. The target price is just the compressed, summarized conclusion of a massive, complex financial model. Furthermore, psychology plays a huge role here.
How so?
Market analysis recently noted that Wall Street was heavily converging on an S&P 500 target near 8,000. Now, part of that is based on hard, bottom-up earnings data, but part of it is simply because 8,000 is a nice, round, psychologically attractive number for humans to anchor to.
That's hilarious.
It really is. Target prices are often just a lagging indicator summarizing the market's current mood. In a raging bull market, analysts constantly revise their targets up to chase the rising stock price. In a bear market, they chase it down.
So if a massive chunk of this is just packaging complex math into a nice psychological bow for a hedge fund client, it begs a really vital question of independence.
It certainly does.
I mean, you look at how these massive Wall Street brokerages operate, and they aren't exactly neutral academic observers just calling balls and strikes.
No, not at all. There is a deep historical and structural reason for investor skepticism here. You have to remember the business model.
Okay, tell us about it.
Major brokerages do not just do equity research. They do investment banking, they handle initial public offerings, they run massive trading desks, and they issue corporate debt.
They're essentially playing on both sides of the field, acting as the referee and the team owner.
Exactly. And because of this structural reality, official regulatory guidance from the SEC explicitly advises investors to check if a brokerage holds stock in a company or does investment banking for them before blindly trusting a research report.
That's a huge disclaimer.
It is. Now, there are strict rules in place today. FUNR Rule 2241 exists specifically to prohibit analysts from giving favorable target prices just to win investment banking business from a company.
Which is good.
Yeah, it requires strict internal policies to manage and identify conflicts of interest, and it prevents research reports from being selectively handed out to a brokerage's internal trading desks before the general public gets them.
But rules printed in a handbook are one thing. Human nature and corporate pressure are another entirely.
Very true. Direct bribery or blatant quid pro quo is highly regulated and highly illegal. But relationship maintenance is not.
Oh, relationship maintenance.
Think about the soft, unspoken pressure an analyst faces. If an analyst writes a brutally negative, highly critical report about a major company's accounting practices, that company might suddenly stop taking the analyst's phone calls.
Right, they get frozen out.
They might lose exclusive access to the chief financial officer during private corporate meetings. So as an everyday investor, you must view these target prices not as independent, objective truths handed down from a mountaintop.
What are they then?
They're professional opinions with managed but not fully eliminated conflicts.
Here's where it gets really interesting. Where is this most dangerous for the everyday American investor? It is not in your boring, stable utility stocks or insurance companies where cash flows are highly predictable.
No, definitely not.
The danger zones are the theme stocks, the highly cyclical stocks, and the high multiple growth stocks. Just look at the data for Micron in June 2026.
The perfect example.
It really is the perfect example of the danger zone. It hit a $1.39 trillion market cap, seeing a massive 17% jump right after an earnings report based on $22 billion in customer commitments.
The numbers were staggering.
On paper, everything looked utterly flawless. The target prices from analysts were likely shooting to the moon. Yet, as we mentioned earlier, the broader semiconductor index violently shook that exact same week. When a beginner investor sees a massive upside target on a volatile tech stock like that, they shouldn't see a promise of guaranteed money.
No, absolutely not.
They should actually see a massive warning sign of uncertainty and a wide distribution of possible outcomes.
That is the core takeaway regarding risk. A high target price on a highly volatile stock is not a promise of high returns. It is a promise of high variance.
Meaning things could go incredibly right or incredibly wrong.
Exactly. It means the potential outcomes are going to be wild. In one direction or the other. You have to brace for impact.
Okay, so we've talked about the mechanical flaws, the lagging models, the psychological anchors, and the hidden biases. Let's give the listener the ultimate playbook.
Let's do it.
How does an everyday investor actually use this target price information intelligently in their own portfolio without falling into all these traps?
Well, the absolute biggest trap, hands down, is the simple math trap.
The simple math trap.
Yeah. You look at a stock trading at $100, you see a fresh target of $150, and you say to yourself, great, that's a guaranteed 50% return, I'm going all in.
Oh, man, yeah.
You cannot do that. The second biggest error is trusting the average consensus target price.
Why is the average bad?
As we discussed with the wide ranges, if you take a wildly optimistic report and average it with a deeply pessimistic report, you just get a completely useless middle number that represents absolutely nobody's actual conviction.
It's like taking directions from a passenger who says turn left and another passenger who says turn right and deciding to compromise by just driving straight into a brick wall.
That's exactly what happens to a lot of portfolios.
Ouch.
So here are the actionable steps based on the research. Step 1, look at the why.
The why?
Why did the target price go up? Did it go up because actual, tangible earnings per share, what we call EPS, went up?
Meaning the company actually sold more products and made more real profit.
Right. Or did the analyst just raise the price to earnings? Multiple expansion is a massive trap.
Multiple expansion. Can you explain that simply?
It's when a stock's target goes up simply because the broader market is feeling euphoric and investors are suddenly willing to pay $40 for every $1 of company profit instead of the $20 they were paying last month. The company didn't get any better. The crowd just got more reckless. If the target price is based purely on multiple expansion, that is a much weaker foundation than actual profit growth.
Okay, so step 2. Read the extremes. Don't look at the average. Look at the highest target price and the lowest target price on the board.
Yes. Split those targets into the absolute best case scenario and the absolute worst case scenario.
Because you need to know what you're really risking.
Exactly. A truly great, resilient investment isn't just about having a high ceiling if everything goes right. It's about having a survivable floor if the worst-case scenario actually happens. You need to read the logic of the most pessimistic analyst covering the stock, not just the cheerleader.
Step 3. Never, ever use a target price percentage to dictate your portfolio size. Just because a stock has a theoretical 50% upside according to one analyst doesn't mean it should make up 50% of your retirement account.
That is a recipe for disaster.
You have to consider your own timeline, your need for cash liquidity, and your own personal risk tolerance.
Definitely. And step 4, watch the market reaction, not just the report itself.
Whoa, this is a big one.
This is crucial for understanding what is already priced in. If a glowing, incredibly optimistic target price upgrade comes out in the morning and the stock price barely moves or actually goes down by the end of the day,
Then what?
that tells you that all the good news was already expected by the market. The expectation is already maxed out.
The hype was baked in.
Yes. Conversely, if a terrible report comes out, violently downgrading the stock and the stock holds steady and doesn't drop.
The market has already absorbed the risk.
Exactly. The bad news is fully priced in and the sellers are exhausted.
The market's physical reaction to the target price on the trading screen is vastly more valuable data than the target price itself. It tells you what the crowd actually believes rather than what the analyst wrote.
This raises an important question for every investor listening to this.
What's that?
Are you buying the company's actual underlying business fundamentals? Or are you just buying one analyst's highly optimistic conditional scenario?
Such a good point.
Target prices shouldn't be a shiny buy button that you press without thinking. There should be a checklist to verify your own logic. They give you the specific variables to watch, like revenue assumptions and profit margin expectations, so you can make your own informed decision when those actual numbers are reported.
It's about using their heavily researched homework to check your own answers, not just blindly copying their test. Which leaves us with a final, provocative thought to ponder. If analyst target prices are so often just a lagging indicator of market sentiment, if they're essentially just chasing the stock up in bull markets and chasing it down in bear markets, what real-world indicators should you be looking at? How do you spot the shift before the analysts finally update their spreadsheets? Perhaps the secret to investing isn't finding the smartest analyst who predicts the highest peak. Perhaps the real secret is finding the analyst willing to outline the clearest, most honest, worst-case scenario so you know exactly what kind of blizzard you might be driving into. Don't forget to subscribe and hit that like button.